What if financial freedom wasn't about working harder, but about making your money work smarter? Welcome to the Glovisor Podcast, where we explore business growth, communication, leadership, and personal development through real conversations with people that make an impact. Today's guest left behind a successful engineering career to build a real estate empire of more than 10,000 units and over $2 billion worth in acquisitions. Through his investing platform and top-ranked podcast, he's helping hardworking professionals escape the rat race by using the same wealth-building strategies trusted by the affluent and high-net-worth individuals. Glovisor welcomes Lane Kawaoka.
Hey, thanks for having me, Joe. Hello, everybody.
Great. Looking forward to this conversation. I just couldn't believe when I heard the $2 billion in acquisition. I said, that's an impressive number. It's hard to conceptualize, so I can't wait to hear more about it. So Lane, tell us, what is it that you do?
Yeah, so today I'm a real estate syndicator. So we'll buy apartment buildings, fix them up and sell it, but we'll also do private equity. So we'll go into all different types of businesses, some online businesses, and do roll-ups. Essentially, the model of buying, not distressed real estate, but maybe slightly distressed businesses and bring in some capital with a plan and then fix it up and sell it, right? So it's kind of the private equity model. But yeah, it didn't always start that way, that's for sure.
When you say roll up, what does that mean? Can you get us on the same page?
I think you can do this a few different ways, right? I think when people think of private equity, they think of these big guys in suits coming in, taking over companies and then engulfing them in their bigger infrastructure, right? Where they may have a larger parent company that does the administrative tasks for that new acquisition, but 4 or 5 others that they have. So that's essentially the term where you're kind of rolling these companies up into the bigger whole. You're finding synergies and, like I mentioned, administration, but you also may have, we've had it where, you have a company that has a Rolodex of current clients that trust you, but you bolt them on to another company that offers different services. For example, company that does SEO services, right? And you may have another company that does podcasting services, right? Just picking something out of the blue. You may be able to offer some of those podcasting services to that first group, right? So you kind of cross-pollinate and you just extract more value out of both companies that way.
Now, are you industry specific?
I think that's where our unique thing is. Like, as far as businesses goes, we're somewhat agnostic. If we can find an operator that we know, like, and trust, and done business in the past, we'll kind of follow their expertise. It's very different than when we do real estate, right? We are real estate operators. We like properties in the class B and C class. So that means 1970s to 2000s build in certain areas like Texas, Florida, Alabama, Arizona. Certain vintage, right? Certain part of the strike zone if you're a baseball fan. And we kind of stick to that, right? We don't go to senior living. We don't go to high-end luxury residential. We don't go to self-storage, right? We kind of stay in our lane.
You've selected some of the things you don't do. Now, was that by initial design or is that trial and error?
Well, I think when you're the operator, the person doing the actual work, I do think you need to specialize into something. But I think that's where we've kind of evolved over investors is, unfortunately, what you specialize in may not be the best place to invest. No different than, when I first got started investing, I bought rental properties in Seattle, Washington, where I happen to live. Most times, just from a probability standpoint, most people out there where you live is probably not going to be the best place to invest. More than likely, just saying, right? So I think that's where the flexibility comes in, where you need to kind of figure out, all right, where is the best place to invest that I can give myself the best chance? Because investing is risky, right? You need to try and stack the chips in your favor. Or, you can't do this with stocks and stuff like that, but, try and get the most insider trading that you can. And you can do that with real estate and buying businesses. But yeah, going back to, buying the properties, right? Like, I think that's where we realized that we needed to figure out what did we do best and kind of stick to that. And, essentially you're building, I think of businesses and even investing in real estate, no different than like an assembly line. You have to try and find ways to streamline what you're doing and rinse, wash, repeating, doing it again and again. and then streamlining it and making it cheaper. So I mean, essentially, our when we're doing multifamily, our factory is we're renovating units. It may not be like you know very quickly, but we may go through several a month at least. And that's kind of repeatable process that you do for the 200, 300 unit apartment building complex. So, everything can be done a little bit faster, a little bit more efficiently. And, that's kind of the art of specializing in something as an operator.
It sounds that you're doing a little bit more of the buy and hold. Is that the strategy?
Somewhat, right? I think the nice thing about apartments is you could hold on to it in cash flow, right? So it gives you that ability to kind of make your exit strategy somewhat flexible. You don't have to sell when you are done. And that's where, I think, but make no mistake, you have to sell it, right? You don't want to hold on to an aging building. These are commercial assets. They're not like residential properties. Residential properties are a little bit different where with that, you can have a 50-year property be just as good as a 100-year property. You're going to have to put a boatload of money into that 100-year property, and it's probably not going to be worth it. But it does pretty much stay, it could be timeless. Whereas a 1970s property, which we would categorize as a Class C asset, eventually it gets older and older and older, and you can't put lipstick on a pig at the end of the day, right? And essentially, that's what we do. We put lipstick on a pig, try and squeeze the extra value of these kind of slowly dying assets, and we renovate it. We'll bump the rents up a little bit in the process, bump the value of the apartment, and we sell it. We won't be out.
Is there a minimum number of units that you get involved in one project? Or is it by dollar amount?
It's minimum amount of units is kind of the threshold, but we try to push it higher as much as possible. But the two big thresholds is 60 units because you want to have a property manager in the property at all times. When you get under 60, it just doesn't justify a person being there. And this is a big problem with residential real estate. Most times you have a property manager running around all town to his, he's normally a good property manager has like 100 or 200 properties that he barely sees because he's running around 95% of the day driving logistically. And that's what's nice about commercial property management, who's there. They can control the culture of the building. And with 60 units, you have enough scale to justify somebody's salary there. But where I would say you really get synergies is when you start to make it worthwhile to hire a full-time handyman, right? And those types of HVAC staff. That, the threshold would be about 100.
Gotcha. So every successful entrepreneur has a defining moment. Now, what was it that inspired you to pursue this path?
Yeah, I mean, I think I was doing this all by myself, for myself. Bought a rental property 2009, changed it to a rental property. And that was kind of where I realized, wow, the power of residential real estate where you're getting cash flow, tax benefits. The tenants are paying down your mortgage for you with their own heart, sweat, and tears. And you're also getting the appreciation. And I was like, wow, why would I want to do my 401k stuff and ride that roller coaster? And what I realized there was that I was investing primarily into the asset, whereas most people don't realize that they get sloppy seconds by investing to the stock market by getting all these middlemen picking up their returns before they do. So, I think that the takeaway here for investors is try to get as close to the action as you can. However, you got to do your due diligence. There's risk involved with that, right? But if you surround yourself with a community of other investors, you can do well. I think, at least, I speak for myself. But I think that's where investors or I started to realize that doing this myself that there was a transition buying little rental properties. In 2016, I had 11 rental properties, and I was moving to financial freedom. But until I found syndications and private placements investing in more higher quality commercial assets, that's when I really started to realize kind of the light ahead of, and I realized how accredited investors invested. They weren't investing in little rental properties. And that's kind of where I realized like, maybe I should create an ecosystem, a community of people doing this because my parents never owned rental properties. I never had a rich uncle or a credit investor uncle. I didn't know what a credit investor was. So for me, I had to kind of piece this together all by myself. But that was kind of what I realized the need was out there for first generation multimillionaires to find a tribe of other like-minded investors to swap ideas, build friendships, but also find deal flow and do due diligence with each other.
That's what you have today is sort of an ecosystem of people with the same like ideas that want to invest in real estate.
Right, right. And then, they're of course accredited investors. So $1 million net worth or greater, or make over 200,000 at their day job. And, they're in that mindset of scaling their portfolio and allocating their portfolio because they've gotten out of that stage in life where they're just trading time for money.
Collectively, you decide on purchasing certain assets, or is there a manager that handles this type of decision making?
We are the professionals. We are the managers, right? I mean, everybody else are they could do that one day, but many choose to just stay in the passive role, right? So of course, everybody does their own due diligence on their own. Everybody signs their own paperwork, everybody's taking on risk. But as the general partner, right, we're the ones that's kind of guiding the ship.
So the other investors are earning a return on those decisions and on those properties.
The analogy I use, it's like an airplane, right? So in the cockpit, you have the general partners, the people who are running the show, find the deals, they do everything. People come back and coach. They pay the airfill, they get in. They're riding the airplane. They get a piece of the action too. Every deal is structured a little bit different, but essentially the structure of the deal is, at least I like it because the spirit of the deal is everybody's rowing in the same direction, and everybody gets hurt if the plane goes down, even the people in the cockpit, right? But what this now allows investors to diversify into dozens and dozens and dozens of these private investments directly, and so allows them nice diversification.
So it's not property specific, it's more of a group or assets.
It can be both. I mean, a lot of deals, it's just one apartment, so I think that makes it a lot easier for investors to do their due diligence on. And it also, as they get their reports, they can kind of, see the P&Ls of that particular asset. Some are blind pool funds. I particularly don't like these ones. These are more on the institutional side where I just don't think that deals are that great. But they'll put 25 apartments into one fund, one diversified fund, and then sometimes you have deals where it's just 2 apartments, for example, like a 2-pack or a 3-pack, right? So these deals are plentiful out there. Unfortunately, before I was an accredited investor, I just didn't know of this world existed.
If one of our listeners wanted to work with you, what would that journey look like?
I mean, it's not for everybody, right? I mean, there is obviously risk involved. There is no guarantee of any return. Um, but I think in this world, I mean, just like in real estate, it's a relationship business, especially if you've never invested in this type of private placements and syndications before. You got it kind of works both ways, right? I think the investor wants to understand who they're working with, and also the general partner wants to understand who they're bringing in. Is if you said it's not for everybody, and until you're in a deal, unfortunately, you may not know if it's for you from a maybe not risk standpoint, but from a just being able to sit there and coach and relax and be okay with it. The saying always goes, if you can't afford to lose the money, don't invest at all. I think that certainly does apply. But very wealthy individuals, as I learned through my journeys, and I put into my book, The Wealth Elevator, they don't invest off the public markets. They invest off the private markets with people they know, like, and trust.
Interesting. So now we threw around this big number of $2 billion in acquisitions. Explain to us a little bit, how did you arrive to doing all of this?
Yeah, I mean, from my first almost decade, I started investing in 2009 to 2016, had 11 rental properties. That was the stage where I kind of pivoted to going into these syndications and private placements as a passive investor first. And this is the hard part. That's why we created the community. When you first get involved in this world, you don't have a network. You're just going on the internet and finding the good marketers, the unproven operators out there, and that's what I was doing. And my first 15 deals I went into, I wish I wouldn't have invested in 3 of them, but I wouldn't have known. Elizabeth, I didn't have a network. And that was kind of where I realized, well, maybe I should just do this on my own, right? This is where I was a little bit different than other folks. And, other people in the deal with me thought the same thing, and we kind of partnered up, right, and worked together in a smaller group. So initially when we started to do this, and I'd say that was in 2018, we would buy smaller Class C properties. So a lot more beat up, a little older, cheaper, and also smaller too, like 50 units, 60 unit sizes. They were a little bit quicker to turn around because they're smaller, right? You go through 5 units, you're already done with 10%. Where if you're in the 300 unit, you got to do that for 4 more years, right? At 5 units a month, right? But that's what we did. It was difficult working with that clientele, though. When you work with Class C properties, I mean, we tried our best, but most times you're going to get only 80% of the rents to be collected month to month. Like that's
Yeah.
just how it is in that sector. But if you do your job well, you can drastically bump the values on those properties, right? It is a lot more volatile, I'll say, in the lower ranks. So we moved up to more cleaner, nicer Class B assets, went to larger properties. In 2020, went over $1 billion of assets. And, at that point, it gets easier for us, as you could imagine, as you get more notoriety and scale. But that was kind of the trajectory. And then in 2022 to 2024, that was when interest rates skyrocketed and commercial real estate really came down, like about 30%. So, interest rates really impact residential and commercial real estate for sure. People want to understand where interest rates are going. What I would recommend is Googling the Chatham Financial Curve and the CME FedWatch tool. Those are the best predictors that's what the pros use to model out their deals. And they're saying that interest rates aren't going to be coming down anytime soon. It may come down like a half a point later, this year, early next year, but that's hardly anything. Suffice to say, I don't think it's going to be the grandpa's real estate market like how it was from 2008 to 2021 anymore. So, which is why we've also switched to buying businesses and diversified that way. And I personally also want to diversify outside of real estate too. I still hold a large maybe not majority anymore, but big portion of my portfolio in residential and commercial real estate.
You have a very wide and broad macro view of the market. Where do you see the residential and the commercial markets headed in the next 5 to 10 years?
I mean, commercial real estate, I think, has bottomed out. I mean, it's gone down 30% off the peaks of a few years ago. Not a lot of people talk about this because this is not residential real estate, which is in front of everybody's eyes. Commercial real estate's able to hide their pricing a lot better. I think you're going to have a fallout in private credit, which is a different industry. People Google that, they're going to start to see what I'm talking about. But as far as commercial real estate goes, I mean, you still have a lot of new supply hitting the market right now, but nobody started building new projects after 2022, 2023. And those projects take about a year and a half to be born and be leased up. So kind of like how babies take 9 months, commercial properties, commercial apartments take about a year or two. So you're going to see this new supply that's coming on now just drop off the map. So that means no new supply, rents are going to tick off again, and then property values are going to go up from here. But we know that supply dynamic in the next several years, right? Because you can pull permits, so you can see what's happening. The other, on the residential side, I'm not too much on the residential side. You got a different dynamic there with the 30-year mortgages. A lot of people are stuck in their homes, sort of prisoners with their low rates. They don't want to move. As I talk to people, I think that's a big fallacy from a personal finance standpoint. But suffice to say that perception is reality for most of Americans out there. If they think that they have a good 3% mortgage, they're going to stay put. So what that does, it creates it creates low supply, which to me creates this artificial environment where prices stay high. But I don't think the demand is there, right?
Would you be able to share a client success story of someone who's worked with you?
Yeah, I mean, we have a lot of folks that are good savers or have exited their business for life-changing money. Life-changing money is typically $5 million or greater. If you take $5 million and you put it into T-bills, which is your lowest risk, lowest return investment, or life insurance, that's 4 or 5% there. That's 20, 25 grand of passive cash flow a month. Not even doing any of the tax strategies with real estate. That's probably on most for most people. So I think we see a lot of these guys that are essentially running 40 miles long in a 27-mile long marathon. They just keep going because they're not able to transition or land the plane to convert what they've made, what their net worth is, the critical mass, to passive cash flow. And they certainly haven't moved on to the family office stage where they take this good chunk of money and grow it to 8 figures and beyond. That's kind of what we do. We kind of put them in that ecosystem, that chamber with other families, kind of making that move. The first generation multimillionaire. That may not be for everybody. I certainly think, put your own oxygen mask on first, quit your day job, try to get to 4 or 5 mil first, and then choose what you would like to do. If it's just hang out with your kids and enjoy life and just spend the rest, nothing wrong with that. But at least personally, what I try to do for myself in the inner circle is, you take this money and you start allocating. You move from the world of a money creator, trading time for money, to a money allocator. So you're allocating into different projects that are diversified. And then you also teach that to your kids so they don't screw it up.
When I first started investing in real estate, that was in the mid 90s. And back then, family offices were rare. We had a couple of family offices that we would meet with, once a month or every quarter, and we would bring deals and talk about it. But nowadays, I'm contacted by many different family offices. So from your perspective, what's a family office and why do we have so many nowadays?
I mean, a family office, you could have as little as like $1 million, but it's kind of more of a formulaic like prospectus that, hey, we're in the business of investing our money. You have some people with $20 million that are not in the business of investing and just are spending it. They're obviously not a formalized family office. From there, there's a saying that if you met one family office, you met one family office. They're all different. Most of them are not too sophisticated, to be honest. But, for the ones that have at least $20 to $50 million, they'll typically have a small underwriting team, which might be just one guy or some guy on contract. And then somebody who is the chief investment officer who has some experience running these assets, who can kind of interpret what the underwriter does to pick new deals to go into. They're not the operators, remember? So you could probably argue whether finding relationships and the deals is more important than actually picking the right deals, assuming you underwrite it on your side the right way as with the underwriter. This is somewhat what we emulate, right? Like we have underwriting. If not, we do it ourselves. We people pitch deals all the time in the private markets, but they're always using their assumptions, right? Like, in my opinion, very aggressive reversion cap rates. They might be assuming that the rents are going up 5% every year, in a myriad of different items. And what we do is a process is very simple. We take the raw financials, put it into our spreadsheet analyzer, and we underwrite the deal with conservative underwriting. And we kind of put it up against what else we're seeing that month or that quarter, and we try and pick the best one. And so I think what people call this is a multifamily office, where we kind of find deal flow for many other people, and we operate in that. That's kind of our lane in a way, if you want to categorize our business. But yeah, I what I tell people is, as long as if you $10 million or under, you could still have a family office, right? You could be still doing your job. You can still be doing your business, but it's nice when you can kind of titrate up to, now I'm managing $1 million and investing that prudently. And maybe you can invest that in 10 deals at $100 grand each. But when your net worth becomes 4 to 5 million or 8 million, when you want to go full-time family office, you've got the systems in place. You've made some mistakes along the way, small mistakes, so that now when you have enough money, that critical mass to go full family office mode, you can.
If listeners remember only one thing from today's conversation, what do you hope that to be?
For the average listener out there, you may not be at $2 million net worth. What I would recommend is checking out my book, The Wealth Elevator. I think the biggest thing is figuring out where you are in this space-time continuum of wealth building world. So in the book, I kind of created different floors of the building, the wealth elevator. So it's important to understand which one you are. If you're like me, good job, not $1 million net worth, you're probably in the first floor of the wealth elevator. What I would say is just work on buying little rental properties. I mean, that's what I did. Maybe not buy 11, but buy a handful or maybe 3 or 4 and get used to it. And then just, time needs to be your friend here. You unfortunately can't just race up to $1 million net worth. Not at that wrong. That's the hardest point to build the net worth, other than the first 100 grand. After that, once you get to $1 million net worth, things open up as a credit investor, and that's the second floor of the wealth elevator. And we didn't talk about the third or fourth, but I would say, check out the book. And first thing is self-awareness. I know you guys know Gary Vaynerchuk, right? It's a self-awareness, figuring out where you are at first, because there's a lot of financial advice out there, but it's meaningless to a lot of people based on where you're at. Like I don't follow the $6 latte rule. That's silly. But, like for somebody who's in the first floor of the wealth elevator, they wouldn't spend $5,000 to get into the right room. That doesn't make sense for them. They need to save their money and invest it.
Yeah, I totally agree. The whole self-awareness, it applies to just about everything in every investment style. You should know exactly where you are and where you're headed. Sometimes some of these younger guys who get into the game and they want to go big right away. And yeah, it's good to grow your game as fast as you can if it's possible, but also don't spend the $5,000 to get into a room that you don't even know what to say yet or what to ask for.
Yeah, I know what you're talking about. Look, I don't sell multifamily or private equity coaching. I'm not going to tell you the line where you can go, don't start with single family homes, go big, go home, right? I think that's the silliest thing in the world. I believe in this prudent, stair-stepping method. You're the first for the wealth elevator, do this stuff, then get to the second, and do this stuff, syndications and private placements, then branch off to a little bit more exotic stuff. That's where you get outside of the real world of real estate. Don't just, go into angel investing and, exotic things. That comes later in my personal opinion. But a lot of this is just, my own personal experiences kind of going up the elevator on my own.
And if someone wants to work with you, what do you recommend? Start off with the book. Is there something else that you recommend thereafter? Do you have any courses or you do any coaching to help people?
Yeah, I would say check out the book. If they buy the book and they write a review, take a screenshot of it, they can email team@thewealthelevator.com. We'll hook them up with the PDF version. So I know everybody's putting that into their own AI and asking it their own questions. But we'll also give them the PDF or the MP3 version, just in case they can't read too well like me. So we'll read it to you. But yeah, I would say start there, figure out what floor of the wealth elevator you are. If you're an accredited investor, shoot me email Lane@thewealthelevator.com. But yeah, thanks for having me, Joe. Appreciate it.
Yeah, absolutely. No, this has been great information. Is there a website that you want for them to go to?
I'm just going to Amazon and put in the wealth elevator.
Gotcha. Thanks everyone for listening. If this episode inspired you, share it with someone who needs it. And don't forget to follow the Glovisor Podcast for more conversations that make an impact. Till the next time.